Hi traders, Matt here. Now today's lesson is all about the strategy of buy the dips versus buy higher and selling higher. Now these are bullish strategies, so I'd like to take you through both of them, and then we'll discuss when they're both suited or when the risks of both approaches are apparent as well. And then I'm going to show you how I manage those types of positions. So let's get into our charting software and have a look at a couple of trades. So first of all, I've got the S&P 500 index in front of me here. And you can see this is in a long-term upwards trend. And this is the type of scenario we need to be looking for. Buy the dip and buy higher, sell higher require trends in place. So these are directional strategies. Now I'm going to stick with the bullish trend for now, where basically we've got a longer term established upwards trend. The S&P 500 index has been in a long-term upwards trend for some time now. So this is an ideal candidate to show you those types of scenarios. So first of all, let's take a look at what buy the dip strategy is. So the buy the dip strategy is when we have that established trend, what we're looking for is a short-term retracement, and then we're looking for an entry point. Now we compare that to buy high, sell higher. This is also referred to as a breakout strategy. So when we buy high and then sell higher, we're expecting a continuation of the trend. So as it starts to break out, so in this scenario just through here into a new high, then we're riding that trend a little bit further. Now remember that when it comes to trend, that you can never pick the exact bottom and get the exact top. So both of these strategies are about trying to get as much as we can out of that upward swing or the next leg of the broader trend. To help define that trend, of course, we've got our technical analysis, which helps analyze the actual price movement, but you'll also be looking for something that has that fundamental background to it. So if it's a company, you'll be looking for a company that's a growth stock that might meet your criteria for such a company that has strong financials, that has good growth potential over the coming time frame for whatever it is that you like to trade. So with the S&P 500 here, each time we see a slight downwards movement in the market, that would be when we are looking to enter the buy the dip scenario. How I like to approach buy the dip is that I'm looking for a short-term retracement that then has a bullish reversal pattern. So that's where my technical analysis is coming into play. So here we've got a scenario that I've scrolled back in time where the markets have retraced slightly, then we have a short-term bullish reversal. That's defined by today's candle having a higher high, higher low compared to the previous day's candle with its lower high and lower low, which is what has progressed through that downwards retracement. Now that downwards retracement we also refer to as a counter trend movement. So basically, as the trend is broadly going up, we then get a counter trend movement, the bullish reversal, and then continue upwards. So what is the risk with the buy the dip approach? Well, of course, with buy the dip, that bullish reversal gives us a higher probability that that market's going to continue up, but it does not necessarily mean that we are still going to be going up, of course. So nothing is guaranteed in the markets. So here's a scenario here where there was a short dip. It was only a day, so probably not sufficient enough to define a real strong downwards movement there. But we've got a bullish reversal point. We could be jumping into the markets either at the end of this day or into the next day. And then we can see the market continues to go a bit sideways before pushing higher. A better scenario might be here. We've seen the markets retrace back to this blue moving average line here, which is a 50-period moving average. You use that as a medium-term approach. We have a bullish reversal in place through here. We might be looking to go long at that point. We're buying on that dip. And then we see that market goes down a little bit further overall. So the trick to managing a position like this is that when we have the dip and we enter our position, our exit level we want to make sure is at a point where we can safely ride through that trade. So let's say, for example, our exit level is based on this support back here, back in July, a month or so earlier from this position. If we've entered after the dip and we've bought on the bullish reversal pattern, we want to make sure that our exit level is sufficient that we can ride through any downward swing and then potentially have a continuation of the trend overall. The assumption being that the trend that we're in, remember the old saying, the trend is your friend until the end. Now compare that to buying into a new high. So buy high, then selling higher. Just playing with the same scenario here. If we saw this dip, we would be looking to buy on the breakout of this recent highs. So it's formed a mild resistance level in through here, and the assumption is that if we break through here and a continuation of the trend is going to persist, then we're buying high, then we're going to sell it higher. As we know, we saw this just a moment ago, the market didn't break through that level, so we don't get into that particular trade. We may consider it on through here. Obviously, in hindsight, we can see that it's formed another resistance level. So the stronger that resistance level becomes, the more significant the breakout actually is. Here we have a breakout. Towards the end of this day or on the opening of the next day, we decide to go long, and then we manage that trade through according to whatever our management approach is for that strategy. So you can see there that buy high, sell higher has produced a reasonable trade as well. Now for our previous trade, and I'll just leave that on screen here, if we'd bought the dip, well, we've had to ride through a little, we've sweated through a little bit of uncertainty in through here. As long as our exit level hasn't been triggered, of course, we can ride through that. It just means that our money is tied up a little longer, and then, of course, the trend has persisted. So the difference between the buy the dip strategy is that there may be times where your stop is triggered and you exit that trade, and, of course, you then see that the trend persists. That's okay. I'd much rather act on that exit level than find that we lose more money than we're willing to lose off the trade. With the buy high, sell higher, it might mean that we have actually entered at the top of the market. If we take a look at the previous movement, here's our highs in through here, about 245 points. As the market breaks through, we enter a buy high, sell higher. There's not much movement in that. Depending on what our strategy approach is, will depend on whether we actually are profitable. If you're using option contracts, you may actually find that a profitable trade. Otherwise, a 3-point movement on 245 points isn't a great return, so you might not have hit your profit targets yet. And of course, then we start to see some consolidation through there. So depending, again, on your management approach, will depend on whether that results in you exiting that trade or being able to ride through to the next upwards leg. And so that's the risks there for the buy high, sell higher, is that you enter on the breakout and that ends up being a bit more of an exhaustive movement and you find a larger retracement. So again, you end up being stopped out. But of course, as with all strategies, you should already know what your risks are with your positioning. So you're willing to risk X amount of dollars or X amount percent. That will be reflective of your position size. And of course, that should only then be a small percentage of what your overall account is. Otherwise, you run the risk of losing too much money of your account, and it's quite hard to bounce back when you lose large percentages. Okay, so that's the buy the dip versus the buy high, sell higher. The underlying theme to all of that is that it depends on your opinion, your analysis of the strength of the markets. We're in a pretty strong market at the moment. Now, at times, certainly over the last month or so in this market, I've been discussing the overbought scenario. You can see just off our moving averages here that this market has been well overbought in comparison to where its 20-day and 50-day moving averages are. So the short-term and the medium-term trend. For me, that means that I've adopted the buy the dip approach because the positions I've held, I've ridden those through, I've closed some of them out on the way up. Now I'm looking for the markets to dip before I start to go long again. Now, of course, the buy high, sell higher, the breakout approach, that has worked really well at the same time. So I've entered positions on dips in through here, ridden those positions through on the way up, whereas a buy high, sell higher would be buying on the breakout, riding through that little consolidation there, but buying again on the way out and riding that through to where we are now. And so both strategies work well. It just comes down to your opinion on what works well for you. Again, as with all strategies, you need to get some experience under your belt to then form an opinion on what works well for you. My analysis, as I say, is that if we've got a strong market in place, both approaches work well. The buy the dip scenario, for example, just over the last few weeks, hasn't offered an opportunity for new entry. So the buy high, sell higher has offered new trading opportunities all the way through. So just to recap on what we've discussed there between those two strategies, you need to choose an approach that suits your plan, your overall portfolio management plan. Identify the conditions required for the strategy. So again, buy the dip or buy high, sell higher requires bullish trends, an established bullish trend compared to a change in trend scenario. With the action, execute your strategy according to your plan. As always, that is absolutely imperative. You might be thinking one thing, and it goes against your strategy plan. If you do that too frequently, all of a sudden you start second guessing yourself. That is not good trading skills. And stick to your rules for portfolio and position management. I hope you found this lesson helpful. And again, if you've got any questions, please feel free to email me on coach@matthewbrownmentoring.com.